Another day, another story. Behavioral finance is a field that studies how psychological factors and biases can influence financial decision-making. It seeks to explain why people often make irrational financial decisions that do not align with their long-term financial goals. By understanding these biases and their effects, individuals can make more informed and rational financial decisions. One of the most common psychological biases in finance is the anchoring bias. This bias occurs when individuals rely too heavily on one piece of information when making decisions. For example, when purchasing a stock, an investor might focus on its recent price history rather than its long-term prospects. To mitigate this bias, it is important to look at a variety of factors, including historical performance, financial statements, and future growth potential. Another common bias is the confirmation bias, which is the tendency to seek out information that confirms one's pre-existing beliefs while ignoring information that contradicts those beliefs. This bias can be particularly dangerous when it comes to investing, as investors may continue to hold onto a losing stock despite clear evidence that it is not a wise investment. To counteract this bias, investors should seek out information from a variety of sources and remain open to alternative viewpoints. The availability bias is another common psychological bias that can influence financial decision-making. This bias occurs when individuals rely too heavily on readily available information when making decisions. For example, investors may overestimate the likelihood of a certain event occurring if it is easily recalled or if it has recently occurred. To avoid this bias, it is important to consider all available information and not simply rely on what is most readily available. Finally, the sunk cost fallacy is another bias that can have a significant impact on financial decision-making. This bias occurs when individuals continue to invest in a project or investment despite clear evidence that it is not likely to be successful. This bias can be particularly dangerous as it can lead to significant financial losses. To mitigate this bias, it is important to continually evaluate the potential benefits and costs of an investment and be willing to cut losses when necessary. In conclusion, behavioral finance is an important field that can help individuals make more informed and rational financial decisions. By understanding the various biases and psychological factors that can influence decision-making, individuals can take steps to mitigate these biases and make more informed decisions. This may include seeking out alternative viewpoints, considering all available information, and being willing to cut losses when necessary. By taking these steps, individuals can increase their chances of achieving their long-term financial goals. Thanks for watching.